Welcome to Heart of Wealth, your weekly pulse check on the wealth industry. I'm Will Robbins, your host for this week. Today on the show, a month into the Iran-US conflict, we look at what it's revealed about modern markets. We also lift the lid on how allocators are finally taking action. And we see what's going on with inflating fees for financial advice firms. Joining me are two Citywire journalists, Sophie and Victoria Bell, and former JP Morgan economist and full-time academic Alex Dryden. Welcome, Alex.
Thank you very much for having me.
No problem. So this conflict, it's been played out in Iran, in the Strait of Hormuz, but also in the headlines with proclamations from the White House seemingly designed to calm markets. Markets have a tendency to make up their own mind, though. So what are they saying?
I think over the last month, the fog of war has hanged pretty heavy over financial markets, and investors have really probably been stumbling around in the dark trying to work out what happens next here. However, over the last few days, we've seen that fog of war clear slightly. Emphasis on the slightly, I want to be clear here. And we might now start to see an exit ramp where we can start to think about what the market narrative is going to switch to. Prior to the war, it was about inflation moderating, rates coming down, and markets broadly having a sort of a good year, set to have a pretty solid 2026. Now I'm looking at it and thinking, well, actually, the impact of higher energy prices, the knock-on effects to inflation, is going to keep central banks from being able to deliver on those rate cuts. So we're now really in a higher for longer interest rate environment. So don't expect much action from the Federal Reserve, don't expect much action from the Bank of England for the foreseeable future.
So your point there as well is that certain allocations or certain bets that were being made were predicated on like a falling dollar, an environment that's just not happening.
Yeah, absolutely. It was a completely consensus call. I'm sure when you guys were talking to asset allocators at the start of the year, everybody was saying the same thing. Dollar down, positive on emerging markets, particularly places like Latin America. That has been completely scuppered due to the war in Iran. And now what we're starting to see is a lot of backpedaling, a lot of people going, actually, I need to rip up my sort of pre-Iran war script and come up with a new investment thesis. And for me, that looks like higher for longer, higher US dollar, scrap the emerging markets positioning because of that.
So this would be a good point to move on to some reporting and what allocators have been telling us. So Sophie, I'm going to turn to you. The initial response to the war from everyone, it seemed to be, was do nothing. Have allocators changed their minds?
Yeah, so I think it has been interesting. I think with any geopolitical event, the messaging we hear is always the same. It's stay invested, don't make any crazy big changes to your portfolios. I think having spoken to a few asset managers over the past few weeks, this crisis is feeling a little bit different. So we spoke to Stonehage Fleming, who on the one hand are very much staying the course. And I mean, it's to be expected to a large extent. They're a multi-family office. Yeah. They're protecting clients' money over a multi-decade period. They're not going to be making any big changes. But what they are doing is really actively monitoring the situation and kind of stress testing portfolios in the case of worst case scenarios like a closed Strait of Hormuz.
Now, but you had a second story on a similar theme but with a different outcome, and that was Swiss bank Mirabaud. So what are they doing?
Yeah, so they're reacting a lot more defensively. So I met their head of investments and chief economist last week, and they have essentially thrown out their kind of optimistic Goldilocks scenario. They've quite aggressively slashed risk and have actually they're building up in certain portfolios a cash pile of up to 15%. I'd be intrigued to hear your opinion on that.
You're paid the big bucks to make the big calls as the CIO, but a 15% move to cash is pretty punchy. I'd agree with that. I think for me, just listening to the stories and listening to how different asset allocators are trying to navigate this, I think for me in March, what we saw was there was a difference between risk and uncertainty, and that was coming to the foreground. Financial markets are great with pricing risk, but uncertainty is a whole different thing. I can't even attach probabilities to events such as what we're witnessing in Iran, nor can I really tell you from prior scenarios how that filters through into portfolios. And so that's what I think CIOs are really struggling with.
Yeah, so I mean, we're seeing these kind of differences in individual reaction, I think, but one thing that I was seeing across the board is that no one believes this is a short-term blip.
So we'll just move on to our sort of next story now, and Vicky, which is something completely different, I suppose, which is fees, which is always a brilliant topic for us. So look, there's a couple of recent stories saw third-party providers, so businesses who sell their services to financial advice firms and wealth firms, hold or raise their prices. So I want to start with something you've written about, which is the fund platform FNZ. What is it doing?
Yes. Okay. So for those who don't know FNZ is a platform technology provider, and it holds the wealth of 60%. It controls the 60% of the platform market. So that's quite significant. So they don't have the best reputation for service or delivery, and so they've unveiled this FNZ Select. So it's a two-tiered service structure. So all their clients now are on FNZ Core, which is the standard service, and we'll talk about that. There have been a lot of problems with that. But then the Select service is the premium service, and you get, a say in the roadmap, and you get this supposedly better service. But I think a lot of people have kind of questioned, well, those people should be getting the better service really now. Their SLAs are quite high, they're known to be quite high. So what is it that they're actually offering? And also, what clients are actually going to go? This is the thing that I wasn't really able to get to the bottom of, is what do the clients think of this? I haven't heard much pushback. What I think is that clients will go for it, and maybe it's a little bit of a play, as we know FNZ have been trying to raise costs. And so maybe it could be that they're trying to maybe get rid of some of their smaller clients who they're not making much revenue on. So maybe they might say, oh, the bigger clients, you pay more for this, the other ones won't pay so much,
Yeah, financial advice firms will be familiar with the idea of a segmentation exercise. I mean, they may have done it with their own clients at some point. But FNZ is a relied upon, much relied upon technological provider. As you said, it has had some problems that you've reported on. With always about service
and delivery of projects going on for years. Delivery projects,
And so this is so them introducing a higher tier of fees for better service.
For better service, but some people have said, well, they should be getting good service anyway.
Fix those problems.
Fair enough.
Also, the other point that I might bring up that someone, a source kind of spoke to me about this morning was, where are they actually going to get the resource to? Because they are making loads of people redundant. So it's kind of hard to know. And it's kind of, when I spoke to the group president, Roman Riegelman, it seemed to be quite sketchy. I couldn't really quite get to the bottom of where the resource was actually coming from.
It's really interesting, because there's another story that on Citywire I wanted to bring into this, which was an interview with Paul Hogarth, who's the CEO of model portfolio service provider Tatton. And now in that interview, he claimed that his clients, who are advice firms, rarely pushed him on fees that he charges them. So, Sophie, I know this falls into your wheelhouse a little bit. Sort of, what more can you tell us about this?
Well, I think it's interesting. I mean, there's cynic in me would say, of course, he's not going to say clients are pushing back on fees. But I think, it's a common line, and Tatton have been vocal about the 15 basis points, I think, since launching.
Right.
But and a lot of MPS providers will say it as well. I think they argue that that's the point. In this big race to the bottom with free pressures, companies are feeling the squeeze, but 15 basis points is the point where you can still deliver outcomes to clients, but there's still a commercial advantage for them. But I think it will differ between firms. I think Timeline is a little bit different and has come in, as the new entrant with a much cheaper proposition.
5 to 10. We can't really decide whether it's 5 to 10 basis points or 15. We'll have to check that after the show. I suppose with Tatton, I mean, you see it with platforms as well. So there's this race to the bottom for lower fees, and you see certain platforms. They have advisors who are on the platform who say, "This platform has come to me and they've offered me this. Can you match it?" And the platforms are kind of going, "No, you can leave, because we're not going any lower than that." And I think Tatton, in terms of MPS fees, I think 15 bips is kind of at the bottom. Are we at the bottom?
Yeah.
Would you say
Timeline
so?
undercutting it.
I had actually one more surprise question for Alex because of something I saw you talk about today. Alex, tell me, why are Easter eggs getting more expensive?
This is so good. I put this out on LinkedIn and I was talking about
It's a great question.
why Easter eggs have come down. So my wife went and did like our family shopper. We got 6 Easter eggs for £35, and they're not the most fancy Easter eggs, guys. Like it really wasn't. They were Sainsbury's Easter eggs, and I think there was some mini eggs,
Nice.
some twirls, those sort of classics.
Elite, I think.
And the thing about it, as an economist, I was looking at it going, this amazes me that it hasn't gone down. Cocoa prices are down 62% since last Easter, yet chocolate prices at the store, what you're paying, has barely changed from last year.
And the eggs are getting smaller,
And
right?
the eggs are getting smaller because we're seeing shrinkflation, which is really problematic. So I was doing some digging. Why are these prices not coming through? And it's because of how a lot of these chocolate companies buy the cocoa. They buy it on a several months ahead basis, and the contracts take a long time to wind down. So what ends up happening is they're still, excuse the pun, digesting the prices from last year. So we're not actually seeing that passed on to the end consumer, which is just highly problematic in my mind. So no, even the Easter bunny is not immune from the effects of inflation.
Yeah, everyone's still getting Easter holds in the driving.
Absolutely, absolutely.
Fantastic. Well, look, we'll wrap it up there. That's all we have time for today. A massive thank you to our production team and our guests, Sophie Downs, Victoria Bell and Alex Dryden. We'll see you all next week.